Welcome back to the Deep Dive. It is great to have you with us. Today, we are stepping away from the typical news cycle, the stuff happening this week or next quarter, and we are looking a little further down the road. We are staring right into the face of a technology that, frankly, feels like it was ripped straight out of a science fiction novel.
Yeah.
But the fascinating thing, and the reason we are talking about it today, is that the business reality behind it is happening right now, in real time. We are talking about quantum computing.
It really is one of those fields where the hype cycle is just, it's constantly in overdrive. You hear the words quantum computing and your brain immediately goes to these wild places. You think of teleportation or breaking every encryption code on Earth in like a millisecond or solving the secrets of the universe.
I honestly go straight to time travel. Every single time.
Yeah.
I just assume if we crack quantum, I can go back and buy Bitcoin in 2010.
Laughs are first.
Unfortunately, no. None of the sources in our stack today are promising time travel, or Bitcoin advice for that matter. But they are painting a picture of a sector that promises to revolutionize things we actually rely on. We're talking about drug development, material science, logistics, cybersecurity, AI, weather modeling. The list just keeps going.
It does.
Closing.
But we aren't here to talk about the physics. Mostly because I don't want to embarrass myself trying to explain superposition or entanglement without a whiteboard. We are here to talk about the market. Because there is a massive race happening to monetize this tech. And that is really the mission of this deep dive, right?
Exactly. We want to cut through that sci-fi hype and look at the cold, hard business dynamics at play. Because when you strip away the lasers and the absolute zero cooling systems, what you have is a classic business battle. Specifically, we are looking at a David versus Goliath scenario that is shaping up in the industry.
I love a good underdog story. And for our David today, we are looking at a company called IonQ.
Right. And to understand IonQ's position, you really have to understand the term pure play. Okay, let's unpack that term quickly. Pure play. It sounds like a sports term or something.
It just means they are focused on one thing and one thing only. IonQ isn't selling cloud storage for your vacation photos. They aren't trying to build a better search engine to sell ads. They aren't selling video game consoles. They are pursuing quantum computing, full stop. Their entire existence is wrapped up in this one technology.
Which makes them a darling for a very specific type of investor, right? It's the definition of high risk, high reward. If they crack the code, if they win the race, they could make shareholders a ton of money.
And we have to be brutally honest here, they could go to zero.
That is the terrifying flip side. So we have the specialist company, IonQ, trying to survive in a tank filled with sharks. And the big question we're trying to answer today is, can a specialist actually survive against the generalist giants? Because when you look at the landscape, it is crowded.
It is extremely crowded. And that's the first thing you have to understand about the quantum market. It's not just 3 or 4 companies. There are dozens of companies, ranging from these small, pure plays like IonQ, Rigetti, and D-Wave, all the way up to the tech megacaps.
And it's not just a business race, right? It's a technology race.
Yeah.
It's not like the smartphone wars where everyone agreed on what a phone was, a glass rectangle, and just fought over the camera quality.
That's a crucial distinction. In a lot of industries, everyone is basically using the same tools, just trying to sell them better or brand them better. In quantum, nobody has agreed on what the tool actually looks like yet. There are a number of different technological approaches being pursued. Imagine if we were back in the early days of the automobile and some people were building gas engines, some were building steam engines, and some were trying to use giant rubber bands.
And we didn't know which one was going to work yet.
Exactly. We have IonQ using something called trapped ions, which involves suspending individual atoms in a vacuum using electromagnetic fields. It's incredibly precise. Then you have the giants like Google and IBM largely betting on superconducting qubits, which look like those golden chandeliers you see in stock photos, and have to be cooled to temperatures colder than deep space.
So different physics, different engineering, different bets.
And the brutal reality is, it is possible, I'd say likely even, that not all of these approaches will be commercially viable. Many of these companies are simply going to come up short. Their specific bet on the physics might just turn out to be a dead end.
That is a staggering level of risk. You aren't just betting on the management team, you're betting on the laws of physics cooperating with their specific design. And here's where it gets really interesting for me. We assume, because of all the headlines and the hype, that these quantum computers are already blowing our laptops out of the water. We assume they're already solving these massive problems. But the sources point out a key insight. Current quantum computers haven't actually delivered advantages over standard tech yet.
That's the dirty little secret of the industry right now. It is all about future potential. We are investing in what these machines might do in 10 years, not what they can do today. Today, they are finicky, error-prone, and incredibly difficult to maintain. You can't just run a spreadsheet on them.
So if the tech isn't generating profit yet, how do these companies stay alive? Because that brings us to the financial reality. If you're a pure play like IonQ, you don't have a search engine business paying the bills. So let's look at their bank account. What does the David in our story have to work with?
Well, on the surface, it looks pretty good. IonQ has about $1 billion in cash and equivalents.
$1 billion. To the average listener, that sounds like an infinite amount of money. You could buy an island. You could fund a small country.
It does sound like a lot, but in the world of deep tech, you have to look at the burn rate. They are burning through that cash to fund operations, R&D, expensive lasers, specialized vacuums, and the smartest PhDs on the planet. Remember, most startups like this have little to no revenue. They aren't selling millions of widgets. They are relying on equity sales and research contracts to keep the lights on.
So that $1 billion isn't a savings account. It's a timer. It's an hourglass, and the sand is running out.
Precisely. They are operating under immense pressure. They must produce positive results. They have to prove the tech works to get the next round of funding. If they don't, investors and partners might just look elsewhere. The money isn't infinite. It's a runway, and they have to take off before they reach the end of it.
Now, let's bring in Goliath. Because if IonQ is sweating over their $1 billion runway, the legacy tech giants are operating in a completely different stratosphere. We're talking about Alphabet, Microsoft, IBM.
These are the heavyweights. And the difference in resources is, it's almost comical. Let's look at Alphabet, the parent company of Google. In the last 12 months alone, Alphabet generated over $150 billion in cash from operations.
Wait, hold on. I need to pause on that number. Yeah. $150 billion just from operations. That's not their savings account. That's just what came in the door in a single year.
That is the cash flow generated in 1 year, just from search, YouTube, cloud, and so on. And if you look at their balance sheet, they have nearly $100 billion in cash and short-term investments just sitting there.
So let me get this straight. IonQ has $1 billion total to survive. Alphabet has $100 billion sitting in the bank and makes another $150 billion a year.
Correct. And that changes the entire dynamic of the race. Alphabet can afford to fail. They can pour billions into a quantum project, realize it doesn't work, scrap it, and start over, and their stock price might not even twitch. They have enormous resources to devote to development.
They can treat it like a side project.
Exactly. They can hire the same talent, buy the same equipment, and they can do it without the existential dread that if this experiment fails, the company closes tomorrow.
And IonQ has to be right the first time.
Essentially, yes. It is an immense uphill battle. The giants can play the long game in a way the startups simply can't.
So does David have a sling? I mean, does IonQ have anything going for it other than spunk and a cool name? Let's look at the performance. Because money isn't everything if the tech doesn't work.
They do have some wins. And this is why people are still paying attention to IonQ. In October, IonQ set a new world record for accuracy.
A world record is nothing to sneeze at. Accuracy seems like a pretty important metric when you're trying to calculate, complex molecular structures.
It is the most important metric right now because quantum computers are notoriously noisy, they make mistakes, the qubits interact with the environment and lose their state. So IonQ leading the way in accuracy, specifically regarding the fidelity of their trapped ion qubits, is a significant feather in their cap.
So they are proving that their specific approach, the trapped ions, might be cleaner than the giant chandeliers the other guys are building.
That's the argument. They are arguing that their architecture is fundamentally superior for accuracy.
But I sense a but coming.
There is always a but. Despite that record, the sources emphasize that error levels are still a long way away from commercial viability. Being the most accurate broken calculator is great, but you still can't use it to do your taxes.
That is a great analogy. So they are the best of the bunch, but the bunch isn't ready for prime time yet.
Right. And there is another layer of nuance here. It's not just about accuracy. Different quantum models suit different use cases. Think of it like vehicles. A Ferrari is great for a track. It's fast, precise, beautiful, but it is terrible for hauling lumber. A tractor is great for a farm, but terrible for a commute.
So IonQ might be building the Ferrari, but maybe IBM is building the tractor.
Exactly. And the expert consensus is that there will almost certainly be areas where IonQ's products are not the optimal choice. Maybe they aren't fast enough for certain calculations, or maybe they can't scale to the number of qubits needed for other problems.
So the idea that IonQ is going to come in, crush Google and IBM, and become the only quantum computer company.
Is a fantasy. The source is very clear on this. There is almost a 0% chance that IonQ or any single company captures the entire market opportunity. It's going to be a fragmented market. You'll have different machines for different jobs.
Okay, so if they can't have the whole pie, how big is the pie? If we look at the market outlook, what are we dealing with? Because if the pie is big enough, a small slice is still delicious.
McKinsey and Company ran the numbers. They are projecting a potential market opportunity by 2035.
2035. Okay, keep that date in mind, everyone.
Yeah.
We are talking 10 years out. What's the number?
They estimate the market could be anywhere from $28 billion to $72 billion.
Whoa. That is a massive range. That's a difference of over $40 billion. That's like saying, I think I have somewhere between $5 and $50,000 in my pocket. Why is it so vague?
It really highlights the uncertainty. The wideness of that range tells you everything you need to know. Nobody really knows exactly what is going to happen. We are guessing at the adoption rate. We are guessing at the technological breakthroughs. It all depends on when the tech actually becomes useful.
And let's circle back to that date, 2035. That is, let me check my watch. A long time from now.
It's a lifetime in the tech world. In tech, 5 years is an eternity, 10 years is geological. And this is the part that I think is most difficult for the average retail investor to grasp. The source explicitly states that investors need to be willing to wait a decade.
A decade? That is a serious commitment.
Yes. This isn't a buy it today, sell it next month for a profit situation. If you aren't willing to be patient, the source says you are just trading in and out of a ticker, not investing in the company. You have to be comfortable locking that money away and seeing if the technology matures.
That requires a completely different mindset. You aren't betting on the next quarterly earnings report. You aren't betting on the Christmas sales figures. You're betting on a fundamental shift in computing power that might not pay off until your kids are in college.
And you have to size your position accordingly. This is something the analysts were very firm on. You shouldn't be putting your rent money into IonQ. You shouldn't be putting your retirement nest egg into a company that might go to zero. It's a speculative play.
It really puts that billion-dollar cash pile IonQ has into perspective again. If they have to survive until 2035 to really see that $72 billion market mature, can they stretch that money for 10 years?
That is the multi-billion-dollar question. With their current burn rate, it's very unlikely. They will likely need to raise more capital. And raising capital usually means diluting the current shareholders, right? Selling more stock.
Exactly. Or they might get acquired. A company like NVIDIA or Amazon might decide they want that trapped ion tech and just buy them out. Or, as we said, they might lose the race to a company with deeper pockets.
It feels like a marathon, where some of the runners are sprinting and some are driving comfortable sedans.
That's a good way to put it. The startups are sprinting because they have to. The giants are cruising because they can.
So let's try to bring this all together. What does this all mean for us? For the person listening who sees quantum computing in the news and wonders if they should get involved.
It means we are watching a fascinating experiment. We have a pure play, IonQ, that is technically very strong, setting records, focused, agile, but they are operating in a market that doesn't really exist yet, competing against companies that literally print money.
Cash is king, as they say.
In this environment, absolutely. The tech is exciting, but the business case requires immense patience.
So if you're listening to this and thinking, I want in on quantum, the message seems to be, proceed with caution.
Proceed with caution and proceed with patience. Understand that you are buying a lottery ticket, not a treasury bond. It's a lottery ticket where you can analyze the odds, sure, but the outcome is far from guaranteed.
I think that's a healthy way to look at it. You're buying a ticket for a ride that hasn't even been built yet.
And hoping that when it is built, your ticket is still valid.
Before we wrap up, I want to revisit that comparison one last time. The $150 billion in cash flow for Alphabet versus the $1 billion in the bank for IonQ. It really feels like the central tension of this entire story.
It is. It's the tension between innovation and endurance. Startups are often better at innovation because they have to be. They are desperate, they move fast, they take risks that a giant corporation might be too bureaucratic to take.
Hunger is a great motivator.
It is. But large companies have endurance. They can weather the storms. And in deep tech like quantum computing, there are going to be storms. There are going to be quantum winters.
Quantum winters. That sounds ominous, like Game of Thrones.
It is a bit. It refers to periods where progress slows down, the hype dies down, and investment dries up. We've seen it in AI in the past. We've seen it in VR.
And during a winter, you want a lot of fat on your bones.
Exactly. Alphabet has the fat. They can hibernate. IonQ is lean. Lean is good for speed, but bad for starvation.
So IonQ has to run fast enough to outrun the winter.
That's a great way to put it. They need to reach that next milestone, that next breakthrough before the cold sets in.
It's a high-stakes race. And frankly, I'm glad I'm just watching from the sidelines with a microphone rather than trying to manage that balance sheet.
It's definitely safer from here and much cheaper.
Okay, let's recap the situation for our listeners.
Yeah.
We have IonQ, a high-potential pure play. They are focused solely on quantum computing. They could make shareholders a ton of money, or they could go to zero. It is a crowded, complex industry where cash is absolutely king.
And while the tech is exciting, remember that record-breaking accuracy we talked about? The business case requires appropriate risk sizing. Don't bet the farm.
And here is a thought I want to leave you with. We always root for the underdog. We want the garage startup to beat the corporate monolith. It's the classic Silicon Valley dream. But in a market where legacy giants like Alphabet generate $150 billion a year just from operations, can a startup win just by being better at the technology? Or will financial brute force eventually win the quantum race?
That is a question. Can you buy victory in science? Or does genius still count for something?
Something to mull over. Thanks for diving in with us.
Always a pleasure.
See you next time.